Despite beating top and bottom line expectations, reporting record quarterly revenue of $19.2 billion, up 21% year-on-year, Oracle's stock dropped roughly 10% following the release of its Q4 2026 earnings report. Here are the main drivers and analyst concerns. 1. Near-term gross margin compression. The rapid build-out and operational ramp-up of massive new cloud data centers are weighing heavily on short-term profitability. Full-year gross margins for FY26 stepped down by roughly 5 percentage points. Crucially, the newly appointed CFO, Hilary Maxson, guided that FY27 gross margins will experience a further step down due to data center ramp timing and product mix. Analysts expressed near-term anxiety over this persistent margin pressure, despite management's reassurance of a 30 to 40% steady-state OCI margin profile down the line. 2. Massive capex expansion and impending dilution. Fulfilling AI infrastructure demand is forcing Oracle into an ultra-aggressive capital spending cycle. Oracle's actual FY26 capex reached $55.7 billion, overshooting prior guidance of $50 billion. For FY27, management projected a staggering reported capex of $90 billion to $95 billion, a net cash outlay of $70 billion after accounting for customer prepayments. To fund this pipeline, Oracle announced plans to raise $40 billion in debt and equity for FY27, which includes a highly dilutive $20 billion at-the-market equity issuance. 3. Underwhelming FY27 revenue guidance. Oracle closed the quarter with an unprecedented remaining performance obligations backlog of $638 billion, up $85 billion sequentially, driven by $67 billion in new AI infrastructure contracts. However, despite this massive forward visibility, Oracle merely reaffirmed its previously stated FY27 total revenue guidance of $90 billion. The takeaway: Wall Street isn't questioning the demand for Oracle's cloud services. Their 97.5% global GPU utilization rate proves they are booking contracts as fast as humanly possible. Instead, the sell-off reflects a nervous reaction to the sheer scale of the multi-billion-dollar funding test, near-term margin degradation, and share dilution required to transform that record backlog into realized profits.